Okay, so what exactly are ETFs, mutual funds, and index funds, and their differences? Well, I've been investing for over 30 years, and I still meet people who are in the industry and are still confused by the differences between them, let alone the beginner. So I'm here to give you guys the lowdown on the differences between them and their pros and cons, which will allow you to make more informed investment choices. So let's dive in. Well, mutual funds were the first type of fund to evolve from these three investments and has the most history as it was developed by the wealthy for the wealthy in the 1800s. These funds contain a mixture of various types of stocks from companies which can cover any industry type. So the first benefit here is simplicity of being able to hold many stocks from many different sectors in just one investment. Additionally, this approach provides significant benefit for your investment by diversification from just one purchase, which is also a huge expense saving, which is another great benefit. Otherwise, just imagine having to purchase all these stocks individually and its respective cost. Ooh, ouch. So, what do I mean by diversification? Well, if you have a fund that contains 100 companies, which also happens to be the minimum number for a mutual fund or thereabout, this means your risk is spread across these 100 companies, which means if one of them crashes and burns, this makes up only just a fraction of your portfolio, which has the support of the companies to prop up its value. So this is a good way of making sure you have a good spread across the market sectors and types of company. Lastly, the other benefit is a fund is managed by professionals, which is a benefit as you will have an experienced professional making necessary decisions, what to buy and sell, and of course when, based on the market and global economy, which means you don't have to be an investment expert or take the time to follow the market and stocks and make decisions of when to purchase and exit on an investment, saving a huge amount of time. However, this also comes at a cost, as investment professionals to manage these type of investments are generally paid huge salaries and of course big bonuses. This type of strategy is what is called active management, as a fund is continuously evolving and requires continuous commitment of investment expertise resources, which is obviously passed on to the purchaser in the form of around 1 to 2% of your account value. And this is charged whether your account value increases or decreases year on year. The fees can really add up over the years, so the bottom line is you get significant benefits, but ultimately you have to pay for them. So to recap, mutual funds provide simplicity, diversification, cost and time saving, as it's only one purchase. However, there is no such thing as a free lunch, so these cost and time savings come at a significant cost overall to your account in terms of a management fee. Okay, next, so let's talk about index funds. Index funds are passively managed and a whole new type of investment. Passively managed means there is no need for hugely expensive fund managers required, as these funds look to emulate the index which they are tracking. Indexes are an evolving, hypothetical group of stocks which can be categorized by industry sectors such as technology, in the case of the Nasdaq 100. These market index funds use specific formulae to track the performance of a certain group of stocks or bonds or other investments. These investments can even be grouped to track the stock market overall, as in the case of the S&P 500, or the Dow Jones Industrial Average. The critical aspect of these index funds is that they must contain a large enough sample size of the various stocks to represent the overall behavior of the market index they aim to emulate. The formula they use is created to continuously monitor and make their decisions automatically whether the new stock should be purchased or an existing stock sold to make way for the new stock. Because this type of fund works using a formula, the fees are much lower, often lower than 0.1%. which is a fraction of what a mutual fund charges. If you want to learn more about market indexes, please check out my other video which dives in deeper and explains how they are created and what they represent in much more detail. Another great benefit from most index funds is reinvestment. Let's take, for example, a Vanguard index fund. These type of funds allow automatic reinvestment by a direct debit from your bank account, meaning enhanced investment planning and potential gains. Otherwise, you would have to purchase more shares each month, which obviously comes with a transaction cost through trading commissions and more legwork. So let's recap. Index funds provide the following benefit: simplicity, diversification, cheap, and allows reinvestment. Okay, so now for the newest kid on the block, ETFs, or exchange traded funds. These have been around since the early 2000s. These are a type of index fund. However, with an ETF, you can buy or sell in any point during the trading day, just as you could trade an individual stock. Whereas with an index fund, you can only purchase once through the trading day, and that's predetermined by the fund. So the only choice you really have to make when determining between an ETF or an index fund relates to your tradability requirement. By this, I mean, do you need to trade your investment as if it were a stock? Generally speaking, most people who invest in ETFs and index funds are long-term investors and are not looking to frequently trade, so the limitation of trading an index fund once a day is not such an issue, which leaves the real choice of investment related to the index fund or ETF is the basket of stocks it contains, and of course their respective fees. So let's recap. On an ETF, they provide simplicity, diversification, and cheap and tradability. So, in summary, mutual funds were first born to provide the benefit of a pooled investment. The index funds followed, which is a special category of a mutual fund, which is passively managed, meaning much lower fees. And in more recent times came the ETFs, which are a type of index fund, but has enhanced tradability and can be traded just like a stock. So there you go. These are the differences between mutual funds, index funds, and ETFs. So I hope you have a deeper understanding and you can make more informed investment decisions and move closer to your goal of financial independence. So that's it. Until next time, if you got value from this, please hit the like and subscribe buttons and also the bell for live updates on top investment options and more tutorials helping you beat the market. Cheers, guys.